Hi, welcome to EQUISIS Financial Services. We always appreciate your interest in learning stock trading and analysis. Okay, for next few minutes, we're going to discuss about the Japanese way of understanding the demand and supply. It's perfect if I call it as Japanese candlesticks. That's because even about 150 years or 200 years back, there is evidence says that the Japanese people used this method to trade rice. We mean probably this is the oldest form of technical analysis ever we had, but this has been adopted by Western people a bit late. So we're gonna study the interesting concept. This is still valid. We use this for trading about weekly basis. See, as far as the Dow theory is concerned, it's about 3-4 months. That's a basics where you people studied. Then we studied about a price patterns. The double top, double bottom is good for about a monthly traders, or and if someone who wanted to trade for a bit longer term using Dow price patterns, we use head and shoulder. And as far as the flag is concerned, it's really meant for about a week to a month. But triangle is again for a monthly basis. But all this has a different characteristics. But when it comes to candlesticks analysis, I am a different kind of a trader who wanted to buy sell shares within a week. I buy a stock, I hold it for a 3-4 days later. If I see a price movement, I want to sell it. Then your cup of tea is nothing but a candlesticks analysis. Interestingly, this is very easy to do as well. So we see how it works. Again, trade with knowledge and discipline. Ensure that you will be making money in markets. Okay, candlesticks pattern. It is simple and powerful analytical method. We said the line charts does not focus anything on the particular day's price action, whereas the candlesticks studies things in detail. It means you cannot really see so many data points in one stretch. If you wanted to examine what exactly happened in one particular tops and bottom, how things are changing on, that is where you really need a candlesticks. Okay, and this is, as I said, this is discovered by the Japanese people. But no, in later, after 1930, 1940, the 1920, 30s, the followers of Dow and a lot of other technical people who started absorbing the characteristics of demand and supply recognized by the candlesticks analysis, and they started adopting this as a part of technicals. Okay, as far as this analysis is concerned, you should really understand the demand and supply. Whereas the price patterns and Dow theory understands the demand and supply from a little longer time perspective, but this really understands the short-term buying and selling. Okay, and it accounts, as I said, it's a very few days to study, because even if you have so many data points, it is not even visible. So it really studies the very few days, and probably it can provide a short-term trends. Okay, I'm just speaking about the overall candlesticks pattern here, and we generally recommend this for a weekly trader. A day candle is what required, not recommended. We don't recommend people to watch candlesticks analysis, follow candlesticks analysis in intraday charts, because the intraday charts does not have any impact with respect to closing. Because intraday the prices are not closed, the markets are not closed. The daily, weekly are generally powerful, but still we recommend people to watch daily. That's where you find it, a lot of strength with respect to volume as well. Okay, now we move towards the first analysis, which is very simple and very frequently appears. That's called engulfing pattern. Engulfing, it's nothing but covering the previous body. Okay, we see this, it's very reliable, very much reliable. A lot of people follow these engulfing patterns, and it appears very frequently as well. So it's not just about reliable alone. We can actually identify it very often. It appears, and it is very easy to recognize as well. That's the interesting aspect of the engulfing pattern. Okay, the reversal pattern, it is a reversal pattern. Generally candlestick patterns are powerful when it comes to the reversal scenario, because the prices are coming down suddenly. If some buying is happening, that indicates the early buying happening, and some temporary bounce back is expected. So that's a positive reversal. The same way as the prices are moving up, if you find some selling prices, some selling pressure happening, you can find some temporary selling is happening. So this is generally powerful when it comes to the reversals. Okay, let's look at the bullish engulfing patterns. I hope you people can actually correlate the same for the bearish engulfing. So here we are taking examples of only bullish engulfing. Okay, the latest green body should cover the previous red body. That's the first sign. The trading volume might increase during the engulfing day, because that showed, but this is not necessary. This is not mandate. When it comes to price patterns and Dow theory, the volume is almost must. It's because that indicates the medium to long term trading move. I mean, long term, we are always restricting our price forecasting limited to 2 to 3 months. But even that case, the major buying and selling is happening. It is a temporary buying and selling. So it's really meant for a short term move. So the bullish engulfing should appear only after a price fall. That shows a reversal characteristics. Okay, let's look at this in actual, see how it actually functions. See the prices now, you people are seeing the candlesticks. It is coming down. This day it's went up. Once again the price is coming down. The recent price fall is being witnessed. Okay, this is what happening on the day 1 the down, day 2 again down, day 3 slight positive, day 4 again it is down, but the prices are coming down significantly in recent days. And today the price opened at lower, but it managed to recover completely, and today's candle actually covered the previous day's body. Today's body managed to completely cover the previous day body. This is nothing but a bullish engulfing. This is a sign of strength. This is a sign of temporary strength has happened. This is happening because some buying is taking place at the bottom. Okay, so what should be the direction? It's, you should position your trades towards a long side. Where should I buy the stock? Highest of those 2 days, which is today's bullish side or this. You have to identify the highest of those two high, and if the price goes up, you have to buy the stock there. Okay, then probably we have to place stop loss, you know, at the point B that shows the recent bottom. That is a place I witnessed a buying has started happening. So I would really expect the price to stay above this, if at all, if it is a bullish. I am buying the stock expecting the price is bullish, but if the price goes anything below this level, I would try to exit my position. Okay, it means the maximum amount of risk what I'm trying to take is actually the difference of this between A to B. Then how much profit I should expect? It's nothing but the risk what I take is the expected returns. It means if I take the difference of A to B, then I should expect the target of the same on the upside. Okay, now what next? Okay, if you probably understand the candlesticks pattern, it's very easy. As I said, it's about only 4-5 days. If you find this pattern interesting, you can move on to the piercing pattern, which is again some interesting pattern. This is much more powerful than the engulfing even, but that needs little more, more conditions to watch. Probably you can check out this video. If you find this video is very useful, we again request you people to share this in your social network. And if you have any viewpoints to add, probably you can put it, post your views in the below comment box. We always appreciate your feedback. We try to respond it as early as possible. Okay, thanks for watching this video, and good luck and happy trading.